All right, let's dive right into this. Welcome to today's Explainer, where we're basically stepping into the ring to look at the ultimate heavyweight bout of the financial markets. In one corner, you've got betting on growth, and in the other, betting on decline. Now, these are the two foundational ways to generate returns, but let me tell you, the mechanics making them tick are absolutely worlds apart. Today, we're going to break down exactly how these strategies work, the risks involved, and the wildly different mentalities you need to actually pull them off. Let's get started. Here is the tail of the tape for our matchup today. Round 1, the traditional profit engine. 2, flipping the script, shorting. 3, head-to-head risk profiles. 4, anatomy of a squeeze. And finally, 5, the psychology of trading. Starting off with round 1, the traditional profit engine, the power of buy low, sell high. So traditional investing, or going long as it's called, is conceptually pretty straightforward, right? You allocate your capital, you buy an asset like a stock or an ETF, and you just hold it. The profit engine here works through two main channels. First up is capital appreciation, which literally just means selling the asset for more than you paid for it. Then you have cash flow, which hits your account as dividends or interest payments while you're holding that asset. I actually like to think of this strategy as having this massive built-in macroeconomic gravity working in your favor. As a long investor, you're essentially floating comfortably upward with the market's historical biases. Major indexes like the S&P 500, they've historically trended up over long time horizons. And why is that? Well, because of inflation, corporate innovation, and overall global economic expansion, you're essentially aligning your money with the natural, long-term upward trajectory of human progress. Moving to round 2, flipping the script, shorting and profiting from the fall. Now, you might be wondering, what if I actually want to bet on a decline? How on earth do you profit when a company is actively failing? Traditional investing harnesses that upward gravity we just talked about, right? But shorting attempts to actively fight it. It's a strategy that exploits market inefficiencies, overvaluations, and corporate downturns. So instead of buy low, sell high, the short seller is trying to sell high, buy low. But since you obviously can't sell something you don't legally own, it requires this highly specialized multi-step process. The mechanics here feel totally out of order if you're used to traditional investing. Let's walk through these 5 steps because it's fascinating. Step 1 is the borrow. You literally ask your broker to locate and borrow shares of a stock that you think is overvalued. Step 2, the sale. You immediately sell those borrowed shares out on the open market at the current price, and you pocket that cash right then and there. Step 3 is the wait. You sit back and you wait for the stock price to drop. Now, during this time, you do have to maintain a margin account to collateralize that borrowed stock. Step 4 is the buyback. Traders usually call this covering. To close out your position, you go back to the market and buy the exact same number of shares, hopefully at a much, much lower price. And finally, step 5, the return. You hand those newly purchased shares back to the broker you borrowed them from. Your profit is the difference between your initial sale price and your lower buyback price minus a few fees. But here is the absolutely crucial point to remember: the legal obligation. Yes, a short seller gets cash up front, but they take on a strict, binding legal obligation to return a physical asset in the future, absolutely no matter what it costs them to acquire it. Which brings us to round 3, head-to-head risk profiles, the math of exposure. Let's just put 10 grand on the table to really show the terrifying asymmetry that short sellers have to accept. On the long side, traditional investing, if you invest $10,000 in a company, your absolute worst-case scenario is that the stock goes to zero. You lose exactly $10,000. That's it, your loss is strictly capped. But your upside, the company could grow by 500%, 1,000%, or more. Actually, mathematically speaking, it's infinite upside. Now flip it over to the other side. If you short $10,000 worth of a stock, your absolute best-case scenario, your max profit, is capped at $10,000. And you only get that if the stock drops to absolute zero. But what if the stock surges instead? What if it shoots up to $300, $500, or $1,000 a share? Remember, you still have to buy it back to settle your debt with the broker. Which leads us to this singular, frankly, terrifying reality: infinite. There is literally no theoretical ceiling on a stock's potential growth. And because a short seller is legally forced to buy that stock back eventually, a soaring stock means endless, mathematically infinite debt. Your risk has absolutely no cap. And when you look at the day-to-day operational realities of these two strategies, the differences are huge. Investing is structurally passive, and it's cheap. Buy and hold investors can leave their capital totally untouched for decades. They just pay some basic execution fees and, eventually, favorable long-term capital gains taxes. Shorting, on the other hand, is incredibly expensive and inherently temporary. You're measuring a short's time horizon in days or weeks, not decades. And that's because of friction costs. As a short seller, you have to pay stock borrow fees. These are basically annualized interest rates just to lease the stock. And for heavily shorted companies, those rates can top 100%. You're also paying margin interest. Oh, and get this. If the company happens to pay a dividend while you are shorting it, you are legally required to pass that dividend payment through to the true owner of the shares, straight out of your own pocket. It is a constant, heavy cash drain.
Round 4. Anatomy of a squeeze. The ultimate danger.
So remember that infinite risk we were just talking about? A short squeeze is what happens when that exact nightmare becomes reality. It's a violent, chaotic chain reaction. Just imagine a heavily shorted stock suddenly spikes in price. Short sellers look at their screens and see their accounts bleeding out with uncapped losses. To stop the bleeding, they completely panic and rush to buy back the shares to close their positions. But because they are all trying to buy at the exact same time, while traditional investors are also piling in on the momentum, it creates this acute, massive supply shortage. The buying pressure goes off the charts, and the stock price shoots up vertically. During a squeeze, the actual price of the stock completely decouples from the underlying corporate fundamentals. It stops being about the company entirely and becomes purely about supply, demand, and panic.
And to show you just how devastatingly real a short squeeze can be, we have to look at a couple of legendary real-world examples. Back in 2008, Porsche executed this surprise maneuver, essentially cornering the market and triggering a massive short squeeze on Volkswagen. VW shares briefly spiked from under 200 euros to over 1,000 euros. For a very brief, surreal moment, Volkswagen was literally the most valuable company in the world. It completely devastated institutional short sellers. Then, of course, we had the GameStop saga in 2021. Retail traders coordinated online to target a stock that had a short interest exceeding 100% of its available float. The resulting squeeze drove that stock price up by thousands of percent in a matter of weeks, literally bankrupting prominent hedge funds. It is wild stuff, but it proves that infinite risk isn't just some chalkboard theory. It can wipe out billions in days.
And that brings us to our final round, round 5, the psychology of trading, winning the mental game.
It's crazy to see the stark contrast in the brains required for these two approaches. Traditional investing, that strategy thrives on serenity. It requires patience, emotional detachment, and just putting in time in the market. A long-term investor sees a 20% drop during a market correction, and they don't panic. They treat it like a discount, a buying opportunity to lower their average cost. They sleep pretty well at night. But shorting? Shorting requires a constant, high-stress level of vigilance. Because a short position can completely unravel overnight and bankrupt you, these traders literally cannot rely on their emotions. They have to rely on heavily automated risk management. They use incredibly strict stop-loss orders, which are these automated triggers that buy back the stock instantly if the price rises past a certain point, just to prevent total catastrophe. They also have to use super tight position sizing. They'll limit short positions to tiny, tiny fractions of their overall portfolio, like 0.5% or 1%, just so a single short squeeze doesn't trigger a total margin liquidation. It is an intense, everyday grind. Which really brings us to the core strategic takeaway for this explainer, perfectly summarized by this quote from our source material. Shorting is not a tool for wealth accumulation. Rather, it is an advanced mechanism for risk management and tactical speculation. For the vast majority of us out there, traditional investing is the vehicle for real wealth creation. It benefits from compounding interest, it's cheap to maintain, and the risks are strictly defined. Shorting is not for building your nest egg. It's a highly advanced mechanism. Big institutional portfolios use it mostly as a hedge. They short weak companies to protect themselves from broader market crashes while keeping their core long positions safe. For an everyday trader, jumping into shorting requires intense education, active margin accounts, ironclad boundaries, and total acceptance that your downside has no floor. So I'm going to leave you with this final thought as you reflect on your own financial goals and your own tolerance for risk. Are you going to harness the natural upward gravity of the market to quietly and patiently build your wealth over the next few decades? Or do you genuinely believe you have the strict discipline, the specialized tools, and the mental vigilance it takes to step into the ring and fight that gravity? Thank you so much for joining me for this explainer. I hope this helped clear up the absolute worlds of difference between going long and going short. Keep learning, stay focused, and I'll catch you in the next one.